Hi guys, we're here to discuss Chapter 11, Project Analysis and Evaluation. This is the key concept and skills of this chapter. We're gonna discuss sensitive analysis, scenario analysis, bakit natin kailangan dalawang tools na ito, medyo familiar na tayo sa break-even points pero mas focus pa tayo sa details, cash break-even, accounting break-even, and financial break-even. And also, we're gonna discuss capital rationing. Ito yung mga required corporate finance skill kung interested tayo na mag-work as corporate finance people in the futures. These are a must skills. Chapter outline. In this chapter, we're gonna discuss about evaluating net present value estimates by looking at scenario and sensitivity analysis and how they imply to us kapag tayo ay nagdedesisyon. We're gonna discuss the concept of break-even, operating cash flow, sales volume, and break-even, and finally, capital rationing. First is evaluating net present value estimates. Net present value, one of the important financial indicator kapag tumitingin tayo sa mga investment project, pero yung NPV is just an estimate dahil gumagamit tayo ng several assumption. Ang mahalagang tandaan is that we are estimating pagdating sa cash flow ng isang project. Siyempre gusto natin ma-assure na yung estimate natin ay accurate. Tandaan natin na ang positive present value ay great start but we need to look more on details. The fact na positive yung net present value estimates natin ay isa itong indication na tama yung ating projection. So, there are two possibilities kung bakit naging positive ito. Una, yung proyekto na gagawin natin ay meron talagang positive NPV. Pangalawa, ay kaya lamang naging positive NPV ay dahil di accurate ang ating estimation. For example, ang projected cash flow natin in year 4 is 20,000. The question is, does this mean that the cash flow will actually be 20,000? No, but it could happen because the 20,000 projection is based only on what we know today. Therefore, the cash flow of 20,000 ay maaaring mabago ngayon o sa paglipas ng panahon. Sa madaling salita, ibig sabihin lang dito na kapag pinag-add mo lahat ng possible cash flows na mag-occur sa 4 na taon at in-average mo ito, the result would be 20,000. So, hindi natin ina-expect dito na ang projected cash flow natin ay eksakto makukuha sa isang taon lamang. What we do expect is that if we evaluate a large number of projects, our projection will be right on average. Forecasting risk. The possibility that errors in projected cash flows will lead to incorrect decision. Also, estimation risk. Ang tatandaan natin, a positive net present value can mean one of two things or combination. Meron tayong good project or we did a really bad job at estimating. Kaya kailangan natin tingnan yung forecasting risk. At kung ano yung forecasting risk? Forecasting risk, ito yung posibilidad na merong error sa cash flow ng estimates. How sensitive are net present value? How sensitive it is to change if our cash flow estimates change? Mas sensitive, mas greater yung forecasting risk. Kaya need natin tingnan at i-assess yung economic reasonableness of our estimates. Tinatanong natin why does this project create value? And maybe we're looking at things tulad ng project characteristic, like yung pagkakaiba-iba ng product, yung cost advantages, what kind of things are adding value. Some things we need to consider when focusing on what adds value. Basic principle of economic is that positive NPV investment will be rare in highly competitive environment. So kung maraming competitor, we may not have net present value na positive kapag gumagawa tayo ng capital budgeting and assessment. Kaya need talaga natin i-identify kapag nakakuha tayo ng net present value na positive in this type of environment. Why are we estimating well? And bakit yun nangyari? Dahil over time, prices will grow. Isipin din natin yung potential competition kapag tumingin tayo sa value ng project. Kapag tayo lang yung competitor sa market, baka makapag-estimate tayo na maayos. Pero when competitors enter the market, paano? Paano makaka-apekto yung mga bagong competitors sa estimate natin? We really have to drive down. Hindi pwedeng sabihin natin na $8,000 a year for 20 years. We have to take those other variables into effect. So forecasting risk is the chance. How much our net present value, how sensitive our net present value is to change. The more sensitive it is, mas mataas yung risk na involved. Need natin mas maging careful pagdating sa forecasting and mahalaga tingnan natin yung other factors like competition and make sure we take them into our estimating process. Scenario and other what-if analysis. Ang goal ng scenario and other what-if analysis ay ma-assess natin ang degree ng forecasting risk, kung kaya ba i-handle ng kumpanya ang risk sa gagawing proyekto at para malaman din kung saang part mataas ang chance ng success or failure nito. When we are investigating a new project, the first thing we need to do is to estimate the net present value based on our project cash flows. We call this initial set of projection the base case. So kapag may base case na tayo, ang sunod na gagawin ay to investigate the impact ng ating assumption about the future of our estimates. One way to organize this investigation is to put upper and lower bounds on the various components of the project. For example, suppose we forecast sales at 100 units per year. Alam natin na this estimate may be high or low, but we are relatively certain it is not off by more than 10 units in either direction. Therefore, our lower bound is 90 and an upper bound of 110. Naglalagay tayo ng upper and lower bound to any cash flow components kapag hindi natin tiyak ito. Scenario analysis. To evaluate how well we are estimating is called scenario analysis. What essentially we are looking at here is kung ano yung nangyari sa net present value under different cash flow scenario. Ito yung mga dapat nating tandaan. Best case, high revenue with low cost. Worst case, low revenue with high cost. At yung base case is what we truly expect. Best ay normal pa rin, hindi extraordinary, pero better than base. Worst case is worse than base, but not the worst it could be. They are not necessarily probable, pero pwede pa rin maging posible. So pag tinignan natin yung effect of these changes, this different cash flow on net present value will have more information at makikita natin kung yung project ba is worth undertaking. Pag sinabing worst case actually happening is probably not going to happen. Pag sinabing best case and worst case, we're not going extraordinary in here. We're saying just a little bit better than base and a little worse. Illustrative problem. Initial cost ng investment ay $200,000 at yung project ay mayroong 5-year life. Walang salvage, depreciation is straight line, required return on investment is 12% at yung current tax rate is 34%. The base, lower, and upper value are given for unit sales, price per unit, variable cost per unit, and fixed cost. Unit sales, yun yung number of units na ina-expect mo mabenta. Price per unit, how much you're going to change under normal everyday circumstances. Variable cost per unit, variable cost meaning mas maraming unit yung nasold mo, the more the price or the cost will increase, or kapag mas mababang unit naman yung nabenta, the less cost per unit. So this part of the cost of the product fluctuates. That is variable changes as the unit sales change. For one more unit, there is $60 of cost. Fixed cost, hindi nababago kahit gaano man kalaki yung nabenta mo. Fixed cost or FC will be $50,000 whether we sell zero or what under the normal circumstances. The lower is the worst case. Unit sales $5,500, price per unit $75, variable cost per unit $58, fixed cost per year $45,000. Upper is the best case. Unit sales $6,500, price per unit $85, variable cost per unit $62, fixed cost per unit $55,000. Depreciation natin ay $40,000. 200,000 original cost, divide natin sa 5 years life, no salvage value, no working capital requirement. In our base case analysis, una natin gagawin, take and determine kung ano yung overall cash flow from the project. 6,000 units, $80, each would give us $480,000 sales. Cost associated with those sales ay 60 times natin sa 6,000 equals 360,000. The FC is 50,000. Depreciation, 40,000. Ima-minus natin yung tatlong cost or expenses na yun para makuha yung earnings before income taxes na 30,000. Kunin natin yung 34% ng 30,000 will give us $10,200 tax. Kapag sa pagka-calculate ng net present value, ang dapat mong tandaan ay we are calculating present value ng operating cash flows. Para malaman yung operating cash flow, kunin natin yung earnings before income taxes na 30,000 plus 40,000 depreciation minus natin 10,200 na taxes equals 59,800. At 12%, the 5-year annuity factor is 3.6 048. So base case NPV 200,000 plus 59,800 times natin sa 3.6048. Ang base case NPV natin ay $15,567. Sensitivity analysis. Sensitivity analysis. These are point kung saan yung forecasting risk ay talagang severe. So, ang tinitingnan natin dito ay kung anong mangyayari sa net present value when we change one variable at a time. So, what is most sensitive to any changes? This is a subset of scenario analysis where we are looking at the effect of a specific variable. So, mas mataas yung volatility in net present value, the greater the amount changes in relation to one variable, the larger the forecasting risk associated with that variable. So, kailangan natin mag-pay attention kapag nag-estimate tayo ng variable na yon. In this case, makikita natin na they only change the unit sales pero kinumpute na ulit lahat. Dito naman sa second scenario, ang iniba is fixed cost. Tapos, kinumpute na rin lahat. In concept, sensitivity analysis is an investigation of what happens to NPV when only one variable is changed. This is about the sensitivity analysis. Once na na-plot yung NPV against unit sales, makikita natin na yung line na nagpapakita na yung NPV gonna be 0 at some point. Kaya need maging careful with the sales unit drop below this level that will bring project negative NPV. The steeper the resulting line is, the greater the sensitivity of the estimated NPV to change in the projected value of the variable being investigated. Simulation analysis. Simulation analysis is a combination of scenario and sensitivity analysis. Ito ay complex situation na kailangan ng some type of software or computer calculation to complete, but essentially, we're taking thousands of possible outcomes based on probabilities, distributions, and constraints for each variables. So, you're changing all the different variable tapos titingnan natin lahat ng klase ng combination. Yung output na makukuha, yun yung probability distribution or net present value with an estimate of the probability of obtaining a positive net present value. So, yung simulation only works as well as the information that is entered kapag hindi naging careful sa pag-a-analyze ng variable, bad decision can be made. Pwede natin i-combine yung scenario and sensitivity analysis. Scenario, how does present value change an internal rate or return change from if we go our best, worst, base. And then trying to pinpoint kung anong variable yung pinaka-sensitive to change. Sa pag-combine ng dalawa, yung nakakatulong sa atin na nakapag-create tayo ng better estimating technique. lalo na dun sa mga items na that will have major impact on our project. Common tool for analyzing the relationship between the selling and profitability is what we call break-even analysis. Meron dalawang type ng cost na importante sa break-even analysis, variable and fixed. Variable changes as quantities sold changes whether tumaas or bumaba. Fixed ay constant regardless of how much output there is. Fixed cost plus variable cost equals total cost. For example, your firm pays $3,000 per month in fixed cost. You also pay $15 per unit to produce your product. What is your total cost to if you produce 1,000 units? And what if you produce 5,000 per unit? First case, you plan to sell 1,000 units. Fixed cost remain constant 3,000 either scenario, pero yung variable cost will change. Sa unang scenario, 1,000 times $15. So $15,000 would be your variable. Habang yung total cost is 18,000. Sa second scenario, 5,000 times $15 equals 75,000. I-plus natin yung 3,000. Meron tayong $78,000 na total cost. It's all based on how much product, that's what's going to change, and it will change the variable portion of your total units sold. Average cost versus marginal cost. Average cost per unit will be the total cost divided by number of units. Diba sinasabi natin kanina, fixed cost plus variable cost equals total cost. Ang dapat natin tandaan as the number of units increase, this average will decrease dahil yung denominator natin ay mas malaki. We're spreading the fixed cost out over more units as the units increase. The marginal cost is the cost to produce one more unit, which is also same siya ng variable cost per unit. Accounting break-even. Accounting break-even means the sales unit that brings net income to zero. Formula: P stands for selling price per unit, V variable cost per unit, Q total units sold, S total sales, VC total variable cost, FC fixed cost, D depreciation, T tax rate. This is the quantity that leads to a net income of zero. Tandaan natin, net income equals sales minus variable cost minus fixed cost minus depreciation times 1 minus the tax rate. We want that to equal to zero. Paano natin ma-determine yung quantity na kailangan i-produce tayo sa accounting break-even? And the final formula is fixed cost plus depreciation divided by selling price of the product minus the variable cost that will tell us kung gaano karami dapat yung naibenta natin para makapag-create ng net income na zero. Using accounting break-even. Accounting break-even is often used as an early stage screening number, gives managers an indication of how a project will impact accounting profit. If a project cannot break even on an accounting basis, then it is not going to be worthwhile project. Operating cash flow, sales, volume, and break-even. Using accounting break-even. Though ang ginagamit sa project analysis is accounting break-even, we are still more interested in the cash flow since ito yung cash generated by the company through their operation, especially when there is a crucial changes in sales, volume in operations. We need to know the relationship between sales volume and cash flow than the accounting break-even. Accounting break-even and cash flow. Sa finance, di ba mas interested sila sa cash flow than we are in accounting. As long as yung firm walang non-cash deduction, nakakaroon ng positive cash flow. So kapag yung firm just breaks even on an accounting basis cash flow is depreciated. So nagkakaroon ng extra money if a firm just breaks even on an accounting basis, the NPV will generally be zero. A new product requires an initial investment of $5 million and will be depreciation to an expected salvage of zero over 5 years. The price of the new product is expected to be $25,000 and the variable cost per unit is $15,000. The fixed cost is $1 million. What is an accounting break-even point each year? So $5 million will be depreciated to an expected salvage value of 0 over 5 years. Yung price ng new product is $25,000. Yung variable cost is $15,000 and the fixed cost is $1 million. Q is equal to fixed cost plus depreciation divided by price minus variable cost. So, in order to break even on accounting income, need ng company na mag-produce at magbenta ng 200 units. Paano naman yung cash flow? What is the operating cash flow? At the accounting break-even point, it would be the $1 million dahil yung sales would come in as cash. Variable cost would be paid out this cash and fixed cost would be paid out this cash. Pero in depreciation of dinededuct, we get to zero. So net income would not be paid out this cash. So nagkakaroon ng positive cash flow ng $1 million. So ano naman yung nagiging cash break-even point natin? So yung $1 million na depreciation divide sa $10,000 contribution margin or yung difference between selling price and variable cost para maging zero yung cash flow from the project. Dapat 100 units yung need nating isold or less. 3 types of break-even analysis. First, accounting break-even, where net income is zero. Cash break-even, kung saan yung operating cash flow ay zero. Financial break-even, kung saan yung net present value ay zero. So, yung cash will be less than accounting, but accounting will be less than financial break-even. Operating leverage. We look at how to calculate saka kung paano mag-interpret ng break-even for proposed projects. Ang hindi pa natin nagagawa is what determines these points, kung paano sila maaaring magbago. Doon pumapasok yung tinatawag natin operating leverage. Operating leverage is the relationship between sales and operating cash flow. Degree of operating leverage measures this relationship. The higher the degree of operating leverage, the greater the variability in operating cash flow. The higher the fixed cost, the higher the degree of operating leverage. Degree of operating leverage also depends on the sales level you are starting from. Degree of operating leverage is the percentage change in operating cash flow relative sa percentage change in the quantity sold. Formula ng degree of operating leverage, 1 plus fixed cost divided by operating cash flow. We're showing that fixed cost as percentage ng operating cash flow. Pinapakita dito how much fixed cost there are for every dollar of operating cash flow dahil fixed cost must be paid. Capital rationing. Capital rationing occurs when a firm or division has limited resources. Under capital rationing, nandiyan yung soft rationing and hard rationing. Soft rationing, the limited resources are temporary and often self-imposed. Ano yung big deal dito? You may have many projects na meron net present value na positive and hindi mo kayang lahat gawin kasi only have so much in resources. Well, soft rationing occur kapag hindi natin pwedeng gamitin tong resources na to para dito sa project na to. Pwede lang natin gamitin yung gantong resources natin. So, such an allocation is primarily means of controlling and keeping track of overall spending. Corporation as a whole isn't short of capital. Meron silang pera and pwede nila yung mapalaki if gusto ng management. So, pwede magkaroon ng selection ng project to be completed dahil they are soft rationing. Next is hard rationing. Wala lang pera para sa project na yon at hindi natin kayang erase. So, hard rationing again, business cannot raise capital for project under any circumstances para sa malalaki at healthy company. This is probably doesn't even happen. Usually, soft rationing yung nagko-cost para sa particular project na to be undertaken. So, kahit na yung project natin nagkaroon ng positive net present value, those only we're gonna undertaken them due to this kind of rationing the corporation has. Pero pag meron tayong gantong klase ng rationing, especially yung soft rationing, it's the profitability index is grateful to use to determine which project should be undertaken. Which one is gonna be the profitable of this great positive net present value project? Which one will contribute the most in this project?